Hello everyone, welcome back. So in this video, we will explore how to calculate the payoff for both long and short futures contracts on the expiration date. Long position refers to an investor buying an asset with the expectation that its price will rise over time. So the name long implies a commitment to the investment over a more extended period as the investor anticipates holding the asset for a potential gains. It suggests optimism and a positive outlook on the asset's future performance. On the other hand, short refers to the practice of selling an asset that the seller does not own, usually borrowed with the expectation that the price will decline. The term short can imply a brief or limited engagement in the market since the seller aims to buy back the asset at a lower price in the future to return it to the lender. This reflects a more pessimistic view on the asset's prospects. Therefore, being long indicates a bullish attitude while being short indicates a bearish attitude. Now let's move on to the payoff computation of long and short futures contract. Let's say I am bullish on Adani Ports and expect its share price to rise in the near future. However, instead of buying the shares today, I want to lock in today's price and purchase the shares after 3 months. To do that, I can enter into a futures contract. Since I want to buy Adani Port shares 3 months from now, I need to determine the future price at which I can lock in the purchase today. So let's check the market price of Adani Port's future contract as of 17/10/2024. First, Google search for NSE India Equity Derivatives Historical Data. Click the first link which will direct you to the NSE India website. Under the instrument, select Stock Futures. In the symbol field, choose Adani Ports. For expiry, select 26 December 2024 since this matches our purchase timeline. Note that the stock futures typically have 3 open contracts at any time, that is a near month, next month and far month contracts. Each contract expires on the last Thursday of the month and a new contract opens on the immediate Friday. Leave the option type and the strike price fields empty since they are relevant for options and not for futures. Select custom and give the from and to date as 17/10/2024. You can change the dates as per your required timeline. Now, let's look at the historical data to get the future settlement price. The spot price of Adani Ports, that is the underlying price of Adani Ports, is 1394.70 per share. Whereas the future price for 26 December 2024 is 1417.50 per share. This means that if I enter into a futures contract, I agree to buy Adani Port share on 26 December 2024 at 1417.50 regardless of the spot price on that date. My expectation is that the share price will rise above 1417.5 by the expiry date. If it does, I can buy the shares at 1417.50 through the contract and potentially sell them at a higher price in the open market. And since I am bullish, I am the buyer of the futures contract. Now let's assume you have the opposite view. You are bearish on Adani Ports and expect the price to fall. You also want to lock in the price today thinking that the current price is favorable. So we both enter into contract with opposing views. I expect the price to rise while you expect the price to fall. In futures, trading is done in lots. We cannot trade a single share. Instead, we must trade the minimum lot size. To find the lot size of Adani Ports, you can search for equity F&O lot size on Google. Platforms like Dun shows that the lot size of Adani Ports is 400 units. This means that by entering into the contract, I am agreeing to purchase 400 shares, that is one lot of Adani Ports from you, at a predetermined price of 1417.50 per share on 26 December 2024, regardless of the share price on that date. Similarly, you are obligated to sell the shares at the agreed price. Now, let's see what happens on the expiry date or settlement date on 26 December 2024. So, the market price of Adani Port shares could be at any level. Let's assume a range of possible scenarios with prices varying from 1050 to 1650. We will then calculate the profit or loss for both the buyer and the seller of the futures contract based on these scenarios. When I take a long position, it means I have agreed to buy 400 shares at Rs 1417.5 per share on the expiry date, regardless of the market price on that date. So if the spot price on 26 December 2024 is above 1417.5, I will make a profit. If it's below 1417.5, I will incur a loss. So for example, if the spot price drops to 1050, my profit or loss will be spot minus futures into lot size. So in this case, 1050 minus 1417.5 into 400, which will give me a loss of 1,47,000 rupees. So the person holding the long position will incur a loss of 1,47,000 rupees, which will be the profit for the person holding the short position. Now you can drag the formula across the rest of the cells in the Excel to auto populate the data. But make sure to log the cell containing the future price before doing so. Now let's create a payoff graph. First select the spot price on expiry and the corresponding profit or loss for the long futures position. Then go to insert, choose the scatter plot. Looking at the payoff graph for the person holding long future position, if the spot price on expiry decreases, they incur unlimited losses. However, if the price increases, their profits are unlimited. Next, let's do the same for the short futures position. When the person holding the short futures contract expects the price to fall, and it does, they make unlimited profit. But if the price rises, they will incur unlimited losses. So, this is how the payoff for long and short futures is calculated. So, the graph clearly shows that both long and short futures position exhibit a linear payoff with potential for unlimited profits or losses depending on how the spot price moves at expiry. So that's all for this lecture. I hope you found this helpful. Thank you for watching, and I look forward to seeing you in the next one.